Hi, my name is Gervais, Chief Economist at Farm Credit Canada, with a brief commentary on the decision of the Bank of Canada to cut its policy rate today by 50 basis points. Now, there's been quite a bit of momentum in recent weeks for the bank to cut its policy rate by 50 basis points, and I would say that most of it has been driven by disappointment in Q3 GDP numbers. If you look at investment, if you look at exports, they came in under expectations. It's now the sixth consecutive quarter for which we recorded a decline in GDP on a per capita basis. So there's a belief that the economy is not growing at full potential. Now, on the flip side of this, we've noticed a bit of a boost in consumer spending. And the belief there is that the rate cuts that the bank has implemented since really late spring of this year, when the overnight rate was at 5% and it's now down to 3.25%, well, those rate cuts have actually boosted the ability of consumers to spend. Now, going forward, it'll be critical to look at the labor market. Currently, the labor market is weakening. We have employment that is growing at a slower pace than the labor force. Yet we have wages that are growing in between 4 and 6%, depending on which data set you look at to assess, the state of the labor market and wages. So bottom line is that we expect wages to come down as the labor market continues to weaken a little bit. Now, consumers do have quite a bit of savings. The saving rate is up at 7%. So it will be critical to look at for the future state of the economy, linking it back to future decisions of the Bank of Canada to look at the state of the labor market and the ability of consumers to boost their spending. We think, though, that there's still room for the Bank of Canada to loosen up its policy, and then expecting that, in January, in the early months of 2025, we're going to continue to see the bank lower its policy rate. For more information, I encourage you to go to our website at fcc.ca/economics.